Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, February 23rd, 2024. S&P 500 currently sitting at a new all-time high, 5092. I'm David Zarling. I'm here with Ian, always a contrarian McMillan. Is that true, Ian? Are you a contrarian?
There are some that apparently believe that. I don't think what we do is very contrarian, though.
When you say what we do, which is basically follow trends.
Buy things that are already going up.
Yeah, buy things that are going from lower left to upper right on a chart.
And I don't know how many times we've told people, every client, I guarantee you, if you ask them, did Dave and Ian pick tops and bottoms? What would they say? No.
Nope. Because we educate them on that. We're going to be fully invested at a top and under invested at a bottom. And when you say that out loud in a podcast, well, people will be like, well, that's silly. Until you remember that you don't know when a top is. You don't know when a bottom is. Been a lot of top calling lately.
Yeah.
And we haven't gotten it yet.
We were just talking about this before we hopped on here. We get in these, and it's kind of been like this, not the whole rally. Right, we're coming. Let's still remember, we talked about this last week. We had this Zweig breadth thrust back in November, but certainly the last few weeks of the rally, right? We're all aware of, the breadth statistics and momentum, or, new highs, new lows, however you want to draw it up. There's some waning momentum, not to use that word again, but momentum in the market. It would from a lot of different perspectives, right? And so every time we get these, 1 to 2 down days in a row, it's this, kind of like, as my dad would say, tapping the fishbowl. And everyone's like, okay, well, this has got to be it. This has got to be it. And insert your data point of choice. And then we get something in the markets pop. This week it was, going into the NVIDIA earnings. I know you have it written down on our notes of whether we should even talk about NVIDIA earnings. But I guess now we have. Yes, that was the talk of the town. But to my point, right back to all-time highs yesterday on the reaction, or all-time highs for S&P and Nasdaq and Dow.
Yeah. To us, you can analyze earnings every which way from Sunday, but in the end, it's about the price reaction. It's about the interaction of buyers and sellers, the interaction of supply and demand about those earnings. And I guess maybe the most contrarian thing that we're involved in is the amount of times where you see a company with quote unquote negative earnings, meaning like it didn't meet street expectations, yada, yada.
Yeah.
But the price moves higher.
Love it.
Maybe that's the most contrarian thing that we do, is we could care less what the actual earnings are. It's the opinion on those earnings that matter.
Yeah.
And it just is what it is. Like, I couldn't tell you whether NVIDIA's earnings were good or bad, but I can tell you the price reaction from them was positive in the near term. Now, we could look back 3 months from now and say, well, look what price has done since then, and it might be lower. I'm not here to tell people what that's going to look like. But during earnings season, we've seen a fair amount of positive earnings price reactions, and that's what we really care about, and they're confirming the trend. Is that a fair way to present that?
Yeah, I get it. Specifically on video, I think it was David Keller that had a chart of this. Draw your
technician.
Yeah, draw your rate of trends. The broken trend that we had there off the January, to start the year, January 3rd, has really just been a straight line up for NVIDIA. Maybe before this week, 5 red sessions, 6 red sessions the entire year. I'm just eyeballing it. But again, like we've seen with all of the things, breadth, momentum divergences, it just continues. It's one of those markets, right? And there's always 0% chance that when a new rally starts, that it turns into one of these grinders where not everything really lines up perfectly, which I guess is true for probably most market environments.
When you say that, Ian, do you mean like if we had boxes to check of like things we'd like to see,
Yeah, like,
That-
oh, new highs, new lows, goes higher every day. Well, that's obviously that's not practical. Or advanced decline lines, or stocks above, pick your moving average, percent of stocks above moving averages, or however you want to divide up breadth. Wherever it tends to be, obviously Apple has taken a break. I mean, Apple hasn't gone anywhere since we're the same spot we were at June 2023.
Yeah.
And much higher. So I mean, look what we've done without
The
Apple.
largest capped stock
Yeah.
in the S&P 500. No, it's a great point. I mean, and you could even make the argument Apple's at the same level it was, and maybe you said this and I misheard it, January of 22.
Yeah.
So here you have the largest cap stock, not necessarily trending like some of these other things. And that's okay. Like when you look at NVIDIA, and you mentioned barely any red days, but from June of 23 through January of 24, it had moved sideways. And so you get these trends are a lot like rivers, right? Rivers, they rapid and then they pool and then they rapid and then they pool. Like that's the same thing in markets with trends. What you want to see is confirmation of the trend, which is when you have these pooling or consolidation periods that they move higher. NVIDIA's confirmed that. Now, let's take this to another level on Apple. We're consolidating, we're pooling right now. With it being the largest cap stock, what are some potential ramifications of it breaking down? What the market looks like? Do you have any thoughts
That would
or
probably
ways to
be,
go ahead?
and I assume that would be pretty big headwind. It is back below 200%. I mean, it's not having a great week this week, despite
Yeah.
the surge for the Nasdaq. I mean, I guess I had a decent day yesterday, but yeah, we'll see. It would not be great. I mean, we've already kind of seen some other of the megas. What do they call them? Magnificent Seven.
Magnificent Seven, but I don't know what we call them Magnificent Seven anymore because I believe Tesla's outside of that now.
Tesla's gone. That's been
So
day for most of the year. Amazon looks good.
So Ian, if I were to say to you, Apple is negative on the year, while S&P is about +7, that should paint the picture for our listeners that there is a divergence of it's kind of like seeing that all-star baseball player, basketball player, football player be injured on the sideline. It doesn't necessarily bode well for that team, but the league can move on potentially. And I know in our notes you mentioned with Apple, there's two theses that are worth considering here. What are those two theses? Because we do operate a thesis. We're looking at, for example,
I think you mentioned one
thesis would be,
earlier. I mean, if it goes so is this foreshadowing? Are we going to look back in 18 months and being like, oh yeah, Apple going nowhere for 9 months was this for sure sign that markets were running out of steam, unlike a bigger, grand, multi-year picture?
Yep.
Or is it a tailwind for some type of, yet again, some massive move higher?
Oh, meaning that demand returns to Apple
Yeah.
and carries the market higher.
So, I mean, think how much we whine about the Russell. At least it's flat this year. Apple's down 5%,
Right.
underperforming the Russell 2000. I mean, Apple's relative chart has been bad for a bit.
Well, it's been an 18% opportunity cost versus the S&P since June of 23.
Yeah.
And the same thing occurred from late 22 into
That's
early
true.
23. Your point is valid. If demand returns for Apple at these levels on a relative basis, everybody's looking for, we're not seeing these new highs underneath the surface. We're also not seeing new lows, but there is a thesis out there where Apple returns to relative outperformance and it covers potentially more new lows underneath the surface.
Yeah, because Apple didn't bottom till January 2023, and then the S&P bottom in like October.
Uh-huh.
And then, yeah, we got this massive push into 2023. And all we heard about, right, was Magnificent Seven and Apple and blah, blah, blah for 12 months.
That's a great point because here we are. Tesla's fallen off. Apple's fallen off. There's some new leadership, right? NVIDIA's picked up the baton.
Yeah. Google's hanging. I mean, it doesn't have the best relative chart either, but it's hanging around kind of a failed breakout look. We'll see. What's the other ones? Meta.
Well, I was going to say Meta and Amazon have held up pretty doggone good. Remember when Netflix was part of that whole discussion? It's also holding up pretty well. But fair point about Google, fair point, more than fair point about Apple.
Microsoft holding up okay.
And these are the generals, right? We've talked about this in other episodes where, the big cap, large cap, mega cap names need, holding up, can cover a lot of things that are going on elsewhere. Here we are in a market that's had a great start to the year, has continued its strength through what has normally been a weak seasonal period, the second part of February. And I'm not here to say what next week is.
Well, I
We
think
could be
that's
down next
the big ones. When we get this, it's like, okay, right? Okay, well, now season's down is about to kick in. Now it's about to roll out. And then, because it's another one to add to the checklist of, right, we've seen all the charts, talked about it last week. Some start early February, some start mid-February. We get it. It's definitely like no one's arguing the historical data. It just hasn't come through. We talked about this last week, Dave, right? This is an average.
Right.
You're going to have years that are way worse and years that are way better, and they're going to come out average.
And that's a great point, because like 2020, February and March of 2020 had a huge impact on the average, on the seasonality average that we're talking about.
It's a great point.
The fastest correction that we've ever seen in a market, I'm going to get the number wrong. It was either 26 trading days or 36 trading days.
Yeah.
Minus 35% during the COVID crash had a huge impact on the average. And that's markets, though. Like, I'm not here to say that that's.
And we actually had 2016 markets started off horribly and bottomed mid-February.
Right. And so it is information that if we just kind of smooth over the seasonality, and it's the opposite, right? Because there's also return to the average, mean reversion, or reversion past the mean to a more normal. And normal is such a hard word to use, because markets are, by the most normal thing a market does is be abnormal. And what do I mean by that? For example, the industry talks about, you can expect an 8% to 9% return in the S&P 500 on average, but it's the least likely outcome. It's defined by extremes.
Yeah, I can read off. Okay, so what was the number you used?
For the S&P 500 annual return?
So let's say 8.
Yeah, let's say 8%.
So here's what you got. Now, keep in mind, they tell you the average is 8. And when you do your little Monte Carlo simulations, they put in these things and a risk-free rate. So we're going to go backwards, starting with 2023. 26%, negative 18%, 28%, 18%, 31%, negative 4%, 21, 12, 1, 13, 32, 16, 1, 15, 26, negative 36. How many of those were even close to 8?
Right.
The closest one was 12.
And that's where it's so interesting, because by saying you can expect an average return, you're really setting your client up for emotional and psychological failure, because the volatility that surrounds that average is so much greater that you really have to be open to discussing being involved with volatility. It just is what it is. Like, if you want that 8 or 9% return, there is a trade-off. Yeah. And that trade-off is you have to live with the highs and you got to live with the lows. And that's just reality. And this happens across all stocks. This isn't just an S&P 500 phenomenon. It happens on an individual stock basis as well. It happens with small caps. What is interesting is seeing Apple move lower like this on an absolute and relative basis. And yet we're seeing small caps hold steady. I'm not saying that they're outpacing, but they're holding steady. And that's a newer development considering the last 2 or 3 years of information from small caps.
It is holding up there. I know you and Dan have done a really good job internally, that this time around, this visit to 200, well, it did not work out. First time around seems to be a little bit more accumulation versus distribution. Would you say that's fair?
Yeah. Like, they're willing. When I say they, I don't mean some mythical character. I just mean institutions that are managing.
Of Oz, the guy in behind the curtain.
Yeah, right. Yeah. Not that guy with the flames and all that stuff. We just mean institutions that are managing billions and trillions. Factually speaking, like, it's not like a guess. At the current time, they're bidding small caps up and willing to buy them sooner than they have been since 2021. And that's a healthy dynamic. And this goes back to this breadth analysis that you've talked about, where while we're seeing a narrowing in new highs, we're not seeing an expansion in new lows. And a lot of that has to do with what's going on with small caps in the Russell 2000. And you talked about Apple with the two theses. The same thing could apply to the Russell 2000. Is there is a thesis that exists that the second half of the year sees Russell 2000 carry everything, still minus 20% off of its highs. It's far removed from what the S&P and the Qs or Nasdaq 100 are doing.
And I feel like we're waiting for it. I think there's a lot of market participants waiting for it. And then when it's time, when you think our son is going to get Employee of the Month, he just doesn't even like go to. Now today he's having a good day. He got up, got dressed, washed himself. But like yesterday, like, I mean, it is, but I mean, this is accumulation, right? Then, and we would prefer it not to move in a straight line, right? I mean, I think there's times when you say, God, you know, I wish the market would go up every day, but that's not really the healthiest thing.
Well, that's just it. The longer that IWM or Russell 2000, let's use futures, sits between 1940 and 2100, the more it proves that there's an interaction between supply and demand around that level, that they're willing to do business there rather than doing business near 1800. So just the fact that they're willing to carry out an auction on price and small caps at a higher level than they were before, that's really good information. Now, whether it ever gets to a point of outperformance, we don't know. It has been mega. Most recently, it's been mega semiconductors that have carried the way.
Can he outperform his coworkers? I don't know.
Exactly. Like,
well, and then you wonder, right? Like, okay, last time we were here, November 2021, he got promoted. And then lost his job 3 weeks later.
Right.
And then we went into, so I think there's some healthy skepticism, but to your point, this time around, much, much different behavior than the previous 4 times we have visited the 200 area, which was met with immediate selling.
And that's the appropriate way to diagnose it. And I don't know how you diagnose it without charts, what you just described, meaning every time we've reached this level, going back to early 2022, what Ian is saying is once we got to the 2000 or 200 level, 2000 using futures, 200 using IWM, the selling commenced immediately. In the Russell 2000 corrected, 19, 18, 19, 20%. We had a move up into this area. We did pull back, but completely muted from what we've seen before. And it's sustaining. It's not this sharp move lower. It's this sustained hold. And I still go back to the really important point you made, and I don't know how many episodes it was ago, where those breadth thrusts that you talked about from early November into December, the area that's still held up, and I get it, it's like it's flat on a relative basis, but it is the area that led out of there, and that was small caps.
Yeah.
And
we've got the highest 200-day moving average we've had.
Oh, yeah, it's upward sloping, yeah.
There are positive, big picture trends taking place. And then, yeah, I mean, if this does rip, if the thesis comes to fruition and small caps do outperform it at the end of the year, then this coiling sideways move, this accumulation makes total sense.
Absolutely does. And then you consider underneath the surface a bigger area of small caps that also is high beta risk on is biotech.
Biotech looks good. I can't believe I'm saying that.
For good reason, Ian. I mean, biotech's
now we have some internal jokes about biotech stocks. So there's always,
we'll leave those there.
Always a little fishy, but they look good. In fact, if you look at XBI, which is actually S&P, but I think S&P biotech, but I think it looks pretty similar to the small cap chart.
Your point is that, like, when you look at biotech on a relative basis, basically since 2015, it's been an opportunity cost. It's been a place where you paid the price to hold it. And we've held it in limited fashion during that, almost
Hurts.
9-year period, very limited. But now we're at this point where like you've got this November and December. You mentioned Zwig breath thrust. It's just a price thrust or like a capitulation between selling to buying. That small caps have led, and of the small caps, biotechs have led. And so now you have this scenario on your hands where, wait, that's really risk on behavior if you're going to be buying biotechs. That's a really important piece of information. Is we're not saying it's small cap staples that are leading here. It's small cap industrials, small cap healthcare, small cap biotech. Those are the areas that are leading. That's really risk on behavior. And we're kind of running up against the end of our time, but I do want to use that discussion about breadth thrusts and price thrusts. You shared something really great, some research that you did on, I'll describe it as a price thrust type behavior, because we started out the episode with the run that we've seen since late last year, but there's some information that you shared about the past few weeks or more than a few weeks. Can you talk about this? I'm going to describe it as a price thrust that we've seen for going on 3 months, 4 months. Can you walk our listeners through that?
Yes. So, and I don't got this in front of me. I'll go find it real quick. So, over the last it's 17 weeks.
That's the chart I'm talking about. Is the last 17 weeks of price action.
22-ish. We'll call it 23%. And it is people like, especially optically, even if you look at it in log scale, it's a sharp advancement. And I think that side note, I think that also leads to a lot of this disbelief about can't go higher and yada yada and gone too far too fast.
Too far too fast, right?
And that can be true over the shorter intermediate term. You know, maybe this is some type of blow off price thrust. But in the history of the S&P, going back to the 1950s, this has happened 8 times. So 75, coming off the 74 bottom, coming off the 82 bottom, couple times in the, I think 98 was coming off a bottom, or 96, obviously 09. But anyways, point being, we've had this before, COVID bottom. None of these advancements were really even close to leading to a significant top. The market, if anything, they were really kickstarted multi-month and multi-year bull rallies.
Data that you presented, which is basically, you're just saying the last 17 weeks has been historic. And the reason why I can say historic is you're saying this has happened 8 times. Do I have that right? 8 times since the 1950s?
Yeah, this is the 8th.
The 8th time that we've seen this much advancement in the prior 17 weeks.
So what, 8 times over like 70 years?
Right. And each of those, if I'm correct in when I'm looking at this, they were the beginning of an advance, not the end.
They were, yeah. I mean, it's pointing to the fact that we will look back at, obviously there's October 2022, but I think even more so that we'll look back at October 2023 being a significant bottom for stocks as a whole. So, like the New York Stock Exchange. Yeah, there will be a technical bottom, but a true bottom for all participation. And you know what? Speaking of New York Stock Exchange and an NYSE composite.
Okay.
All-time highs this week. Cannot be bearish. Cannot be bearish.
They're willing to buy the stocks within the New York Stock Exchange composite more than they were 2 or 3 years ago, ever. That is,
it could fail
by definition.
It could fail, but I don't have that information yet. So
right. And let me know if our listeners, let me know if you've got future information.
It's the best I can do is make decisions on right. That's why we wait till 2:45 Central, 3:45 East in the afternoon. We want the full data.
We want as much data as we can.
And this says when I pull up a weekly chart of the NYA, it's an all-time closing high. Yeah. Weekly closing high, daily closing high.
And here we're bumping up against the end of our time, but we get to say the same thing about the Nikkei. We get to say the same thing about the DAX. the Nikkei representing Japanese stocks, the DAX representing German stocks, both the Nikkei not having done this since 1989, the DAX, which is highly correlated to US markets, moving out to new highs. So Ian's point is, if you're going to check boxes, there's just so many that have been checked. Does that mean we have a consolidation that goes into summer? That absolutely can happen. Or some type of, remember, 5 to 10% corrections within a market each year is perfectly, that happens.
It happens.
But to the broader, bigger picture, the price thrust that we've seen, the breadth thrust that we've seen, small caps holding up, getting bid, auctioned up at a higher level than before, what we're seeing internationally, even though there are opportunity costs, like I'm not saying you can just go buy international stocks and outpace the S&P 500. At this point, not yet.
That would be ballsy.
That would be, yeah. And that would be amazing. It'd be great. Like, I think there's something to be said for what's going on with China and sentiment with 11 ETFs being delisted.
I think Europe had a good week. We talked about, the DAX breaking out, the CAC breaking out. A lot of the dollar denominated US ETFs moving higher. I know Japan gets a lot of attention from us, as it should, rightfully. But Europe, I don't know, Europe held up pretty well. You mentioned VGK. Don't we have VGK at
VEU, yeah.
1,000?
Yeah, VEU is above levels that VEU representing, it's the Vanguard All World, so it's representing all stocks, not US stocks, is at highs that it hasn't seen since April 2022. There is demand for stocks, and you see things like junk bonds holding up. So if the credit market knows more than the stock market, that's fine. Well, then let's study that within a really nice consolidation on if you take the coupon out for junk bonds. And you highlighted that if you add the payment back in, the coupon back in, we're now at all-time highs in something like JNK.
Yeah, we're pretty close. Yeah, it's
close.
Yeah, I looked at spreads maybe 10 days ago. USHYCCCOAX. I assume that they're
doing just fine.
Yeah, I mean,
and I get it. The dollar is elevated, and I also
year-to-date lows for credit spreads this week.
So you have a cooling off. And so we might be seeing, and again, this is happening in the backdrop of when we talk about markets and skepticism, optimism, euphoria. I make the argument that we're still in skepticism.
For sure, we are in skepticism. This is going to go against this thesis. Is it possible to somehow take a step backwards during a bull rally?
I think it is. I think if everybody...
I think we've gone from skepticism to like somehow then we got a 22% rally and people are even more pissed off.
They want to short it more.
So bad. They want to short it so bad.
You know, I had someone that I work out with who said that he was going to hold his shorts until it's carried out in a body bag. And I obviously advised him against that type of thinking and thesis. I also had a relative that texted me and said, surely there's a crash coming soon. We have clients that are nervous about where the market has moved to this point. Now, sentiment is very subjective to measure. From the information that we do have, from trying to be as open-minded to possibilities, it definitely feels like skepticism is still the sentiment narrative. Now, and I'll go back to when my mom refers to NVIDIA as her own child, I will know we have reached euphoria.
Yeah.
And she doesn't know what NVIDIA is yet. So soon she's going to find out what NVIDIA is, and then she's going to tie her relationship to it, which is what most people do with their investments, unfortunately, psychologically, is they marry their investments, which they shouldn't do. They should marry their wives and just be happy. I mean, yes, maybe there's optimism. I get it, the NVIDIA earnings and what that could potentially mean. That's a very inward, industry-focused sentiment versus what's going on with mom and pop, what's going on with your average investor. And the average investor is not sitting there going, hey, can you get me into NVIDIA?
We've talked about this before. We've talked about it, not every week. We talked about it, definitely mentioned it. And we said that this was going to come back to bite people. Remember, they were so happy to get their 4 and 5% money market and 3-month.
Oh, yeah.
Oh, my God. If I could just get 5% on T-bills, I'd be so happy. And the market gods gave that to them.
Yep.
Now what? So they loaded into cash and they sat back. They took a deep breath. Now I can get a risk-free 4%. This is amazing.
Right.
Now they're all flustered because stock markets
has moved 15 to 20% higher against that.
Yeah. We've got $8 trillion in cash now on the sidelines that clients are going to say, hey, advisor, I appreciate, I know we talked about at my last annual planning meeting that we were happy with 4 or 5%, but the S&P was up 25% and, over the last 12 months. And now I've got FOMO. I guarantee you that's happening. I guarantee it, or will happen.
Right. Oh, yeah, for sure.
That cash comes off the sidelines.
It does.
And then you've got supply, or you've got demand.
And one of the privileges we have as an advisor is guiding individuals from a fiduciary standpoint and saying, it's okay. Like, it's okay to be invested. Like, I understand you want that 5%, but I'm here as your guide. I'm here as the captain of this plane. I'm here as the surgeon in the surgery. That while the surgery seems unpleasant at the moment, it is appropriate that we continue with the surgery and not bail out at this point. We're an emotional bodyguard for our clients. It's really an important process of what we do for our clients is saying, no, like we understand the desire for the guaranteed 5%, quote unquote guaranteed. I say that quote unquote because a coupon can always be missed, but let's stay invested at this point because that's what's in your best interest. And it just so happens that we've seen the market have a Zwig breath thrust, Whaley breath thrust, price thrust that you've highlighted. Could the market correct from here? Absolutely. But within the context of a broader framework. We just had a massive correction late 21 into early 23, where markets corrected anywhere from 25 to 40%, underneath the surface even worse. We're just now reclaiming new highs in something like the New York Stock Exchange Composite.
I will say maybe this is an extreme statement, but the only practice other than buy and hold that would have had, now I guess you throw buy and hold because that's not, but would have had you involved in this full rally is being a trend follower. Every other discipline, for the most part, has thrown their spaghetti at the wall on why this rally has to end, and none of it has stuck so far, except for I'll sell when the market rolls over, and it hasn't rolled over yet. When the market rolls over right now, that's a whole different rabbit hole to go down to, and that's up to each individual person. But the point is here, the trend, we've had a back-to-back down days, and they feel bad, and they feel bad under the surface. And another thing that I think we don't talk about it a lot, maybe we should, but another thing that I think has led to some expansion and participation, and this is something we watch every day, has been the performance of the ETF, Dave. Has led year to date, had a great February. Now it's earnings season, and obviously there's some reactions that certainly helped with that.
But is it momentum that begat momentum?
Yeah.
Like we're definitely seeing momentum in the market. You look across momentum ETFs, Adaptive Select included, and there's momentum has re-entered the market, and it's one of the most prevalent factors in markets, like whether it's value investing, or you're doing the style box, or you're looking at relative strength. Momentum is one of the most prevalent factors. It's not always in play, but the majority of the time it is, and it's back.
I think the top two large blend ETFs this year are momentum. Year to date so far are momentum ETFs. It's ADPV, and I cannot remember the ticker on the second.
Momentum hasn't been with us for a while. And what I mean by that is when you study momentum and what's happening underneath the surface, the first part of 21 is when momentum started to wane. That went all the way into the beginning part of 23. It's not really till these breath thrusts that we saw in 23 that momentum regained. And so momentum can carry an object further than you think. When we think about these different laws of physics, the same thing applies to markets. And I think it's appropriate at this time to highlight Adaptive Select, which does support this podcast. It's listed on NYSE under ticker ADPV, helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. Ian, we've hit the end of our time. We didn't even get a chance to talk about discretionary, home building, luxury brands.
There's a lot of good things out there.
There is. Maybe that's why we paused. Maybe we're about to head into a 45-day pause, but that doesn't kill the big picture. It really ends up being like, if we do get some type of consolidation or correction, will you be able to take advantage of it?
And and what we don't need to forget, don't forget about this weak breadth thrust. And don't forget, when we get into the summer, things get a little rocky. Do not forget we are above 4,800. As long as we're above 4,800 with an upward sloping 200-day moving average, the trend is absolutely your friend.
I couldn't have said it better. I think we got to end it with that, Ian. Appreciate you being on here and doing this with me. Thank you very much. If you love listening to this, give us a high ranking, share it with your friends. We love to get the word out. Ian, anything else?
No, I hope you have safe travels to Minnesota.
Hey, I appreciate it, man. Thank you again for being on here.
Yeah, have a great weekend, everyone.